Good morning and welcome to Charting the Markets on Friday, the 17th of November 2023. Asian markets came off today as shares in Alibaba dropped quite heavily as it was announced that the company no longer wanted to spin off its cloud computing arm and also list its grocery chain. So those weaker equity markets in Asia also had a negative effect on European markets earlier this morning, which opened slightly down. And we can see here on the FTSE 100 on the daily chart that we did open the session lower, but despite disappointing UK retail sales, which fell by 0.3% in October, after a minus 1.1 drop back in September, which was actually downwardly revised, the FTSE 100 managed to still gain and head back up again, as we can see here. And at the moment, we're heading towards the orange line here, the 55-day simply moving average, 7,502. And above there, we've got this week's high at 7,535. So short-term upside momentum, despite negative data pointing towards a slowdown in the UK economy, pushing the FTSE 100 higher, which yesterday fell as a lot of large cap companies basically paid out their dividends. And yesterday's low was made at 7,403, and basically provided we stay above that level from a technical perspective on a daily chart closing basis, further upside is likely to be seen into next week. And if next week we could head above this 7,535 high on this daily financial bed, we could then target the red line here, the 200-day simply moving average at 7,602. So that's still a distinct possibility, provided 7,403 holds as a support level. Now, if you look at the German market, you can see here that the DAX 40 has risen very sharply over the last few weeks and is currently on track for its 9th consecutive day of gains as it is heading towards its early and mid-September highs between 15,992 and 16,044. Now, it would be pretty likely that in that area we might see some short-term resistance cap the advance. But given the strength of this advance we've seen over the last few weeks, it is very likely that over the coming weeks into the year end, we could actually advance towards the July high at 16,532. So that would be our next upside target in case of a break above 16,044, the late August high being seen. With regards to support in case of potential reversals to the downside, well, you can see here the red line, the 200-day simple moving average at 15,661, and it together with the mid-October high at 15,575 should act as support going forward. And if we look at the Nasdaq 100, we can see here that we've also seen a very strong advance by about 12% from the October lows, taking us yesterday intraday to a high last traded back in January of 2022 to 15,978 here on this daily financial bed before the index declined slightly, and did so around the July high. So that's not surprising because it's previous resistance after this very strong ascent. It's not surprising that the index then sort of stalled a bit around that area. And also we had some jobless claims numbers out, which were not as good as expected, and poor earnings by the likes of Walmart, which basically had a less rosy outlook for the rest of the year and was being cautious and even talked about stagflation possibly happening in the US. And basically, we have to see whether the US economy is starting to slow down or not. And that could have an impact on the Nasdaq 100, of course, as well. But from a technical perspective, this very steep ascent here may well be breached, and that's totally normal as an uptrend loses upside momentum but still remains intact. So basically what I'm saying is short term the momentum still points towards a higher prices being seen as long as we stay above yesterday's low at 15,735. But if we were to fall through there and also through the very steep uptrend line at 15,720 or so, we could retest the September highs between 15,628, 15,520. But that's actually pretty good support. And we could then basically continue this advance in the days and weeks ahead. Now, if we were to rise above 15,978, I need to zoom out here to the weekly chart. You can see here that we would then be heading back up again towards the December 2021 high at 16,660 for the Nasdaq 100. And that's very close to its all-time high going back to November of 2021 at 16,769 on this daily financial bet. And what I also wanted to show you is that from a technical perspective, this chart is absolutely beautiful because we can see a very clearly defined bull flag here, which we've broken out of last week. And that basically points towards a continuation of this very strong uptrend we've seen since October of 2022. So further upside very likely to be seen. But since we've had 3 very strong weeks of gains, I wouldn't be surprised if perhaps over the next few weeks we might see some smaller, lower volatility consolidation phases appear on this chart in the coming weeks. But the trend's your friend, and that is pointing higher at the moment. The US dollar is expected to end the week quite a bit lower as US inflation data came in much weaker than expected, both with regards to CPI and also PPI. And we will see whether it can regain some of those losses as it did over the course of the last 2 days or so, as there are several Fed speakers today speaking, and also we've got ECB members and also Christine Lagarde, for example, speaking at the moment. So if you look at euro dollar, for example, which is obviously the inverse of the US dollar, because it's the euro against the US dollar, you can see here that we basically had some very strong gains take us to 108.95. That was a level last traded at the end of August of this year. And we did so yesterday before consolidating slightly above this red line here, the 200-day simply moving average at 108.06. So that basically is our support area at the moment, together with the early July lows of 108.34. And if that were to give way short term, we may retest the mid-September to early November highs between 107.69 and 56. But provided that support area holds, we should actually continue to ratchet up. And you can see here very clearly that we are forming a bottom. We now have a series of higher highs and higher lows, which is the definition of an uptrend. And I would expect us to head back up again towards 109.45, the late August high, over the coming weeks, and also head the mid-June high at 110.12 in the days and weeks ahead. So euro dollar still looking quite positive, and basically from a technical perspective, provided we stay above the last correction low here around the 106.50 area, this trend remains very much intact. Now, the weaker retail sales data out of the United Kingdom earlier this morning, where we had retail sales fall by 0.3% in October versus an expected gain of 0.5%, well, that has led to a weaker British pound. You can see here the euro against the British pound keeps on rising, and yesterday it rose to 87.66, and that was a level last traded in May of this year. And it looks to me as if here also we formed a major long-term bottom, and that we are back in a positive uptrend now since the end of August, as you can see here, and are likely to head up towards the early May high at 88.35, above which we can also see the April high at 88.75. So basically, euro sterling continuing its ascent, and from a technical perspective, we will remain bullish provided we stay above the last reaction low, that is to say a low on the daily candle here, which is lower than the one to its left and to its right. That was made on Tuesday of this week at 86.89. So basically, provided we stay above there, and the red line here, the 200-day simply moving average 86.85, provided that holds, further upside is in store for euro sterling as well. And if you look at the British pound against the US dollar, you can also see that we have slightly depreciated with regards to the British pound on those weaker UK retail sales numbers, and also as UK inflation, basically as US inflation, dropped this week. And you can see here we did rally to 125.06, a level last traded back in mid-September of this year, but then continued to basically trail off over the last few days, and we are now trading below the red line again, the 200-day simple moving average 124.44, and could slide further perhaps to the mid-October high at 123.37. But even so, we are now still in an uptrend, because we formed this bottoming formation. The fact that we closed on a daily chart closing basis last week above the mid-October high at 123.37 is bullish, and basically provided we stay above the last reaction low, that is to say the low from last Friday at 121.87, this trend to me is still bullish. And it means that we should eventually, over the coming days and weeks, head back up again towards the late June low, and also the mid-August low between 125.91 and 126.17. The oil price continues to come off as demand concerns push it lower, and we can see here that we are on track for another week of losses with regards to WTI. And if I basically show you the weekly chart, I can make this much clearer. You can see here we are currently on track for our fourth consecutive week of losses, and are heading back down again towards the red line here, the 200-week simple moving average at $69.88 per barrel. And if you look at the chart here, you can see that on the daily chart, we did try earlier this week on Tuesday to revert to the upside, but we failed at $79.66 along this tentative downtrend line, and basically slid back down below the 200-day simple moving average here in red at $77.98, and are now trading at levels last traded back in July of this year. And it looks to me as if further downside is in store, because after all, you can see here we have a series of lower highs, lower lows, which is a definition of a downtrend. And you can also see that we've now reintegrated this sideways trading range we were trading in between May and June of this year, between $74.70 and sort of $67 mark. So right now we did dip yesterday to $70.38, but it is pretty likely that we will slide further over the coming days and weeks, and the stop loss on such a move would be the last reaction high. That is to say, the high from this Tuesday is $79.66. But as you can see from there, we've already dropped around 5%, no more actually, around 8% from this week's highs. So the oil price really coming off on those demand worries. Also, as we see stockpiles in the US, we saw that yesterday with the EIA weekly report, which was actually delayed last week. So we saw the data for the last 2 weeks coming in much, much higher than expected. So higher stockpiles in the US, less demand going forward by the likes of China and the US, basically pushing the oil price lower at the moment. And we'll have to see whether the OPEC meeting on the 26th of November will give us any more clarity as to future production cuts. And what's interesting at the moment is that despite a production cut of 300 barrels a day by Russia, and also Saudi Arabia cutting its output by about 1 million barrels per day, the oil price has been sliding, as we can see here on this chart, since September of this year, from about $94 now to around $72. So that in itself is a drop of let me just put a marker on here. That's a drop of some 22% or so. So the oil price really not looking bullish at all, but instead pointing towards lower prices still. And that is actually good news for inflation, because obviously energy prices do have a big impact on inflation. And if energy prices were to fall, that together with falling yields at the moment globally could lead to further outperformance with regards to equity indices over the next few days and weeks into the year end, where from a seasonal point of view, equity markets tend to outperform anyway. But let's move back to commodities, and let's have a look at the gold price, because that is also very interesting, because the price of gold, with the slightly depreciating dollar over the last I should say more than slightly depreciating dollar over the last week or so, you can see here that the gold price has managed to rise again and is now on track to hit its psychological $2,000 per troy ounce mark, and perhaps gain further and rise back towards its October high at $2,009. Now, this will be interesting, because if we can rise above $2,009, and to me at the moment it looks quite likely that this is going to happen, well, we would then be heading back up again towards our highs around $2,082, the May 2023 high, and also the highs going back all the way to August of 2020, because all of these highs between that high here, 2075, the March 2022 high at 2070, and also, as I mentioned just now, the May 2023 high at $2,082. So that whole area between 2070 and $2,083 per troy ounce may be reached over the coming weeks. And as you can see here, we've had a very sharp ascent from the October lows, then some consolidation, but now we seem to be heading back up again with regards to the price of gold as well. And the view would be invalidated if we were to fall through the 200-day simply moving average, which once again has held a support here, and to below the mid-November low at $1,932. But that looks pretty unlikely at the moment. Now, one last commodity I'd like to look at is the price of US natural gas. Gas prices have been declining over the last few weeks, not just in the US. And as you can see here, we are now testing our August to November uptrend line. We did so yesterday and held there, and held also along the orange line here, the 55-day simply moving average. But I wouldn't be surprised if today we were to once again fall through this uptrend line and retest the 55-day simply moving average. And if we were to then fall through last Friday's low at $3.12, further downside should take us probably back down again towards the August highs, together with the mid-September highs between $3 or $5 and $3.02. So further downside most likely in store for the price of natural gas. The view would be invalidated if we were to suddenly revert to the upside and rise above this week's high at $3.38, but that looks to me pretty unlikely, and I expect further downside to make its way towards the psychological $3 mark with regards to the US natural gas price. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG.